Welcome back to your Mortgage Minute by onlendhub.ca. If you are renewing this year, the real question is not just whether fixed is better than variable. It is whether you should lock in for 2 years, 3 years, or 5. We have Mouli here. Mouli, why are so many renewers now looking at short-term fixed as the middle path?
Because the decision has shifted from rate chasing to time horizon management. The Bank of Canada policy rate is at 2.25%, but fixed mortgage pricing is still being driven by bond yields and lender spreads, so a borrower can easily see a 2-year fixed price lower than a 5-year fixed without taking on variable rate risk. A short-term fixed gives you payment certainty now, then gets you back to the market sooner if conditions improve. For someone renewing into a higher payment, that can be the difference between control and feeling trapped.
Let's make that concrete. Suppose a homeowner has a $400,000 mortgage balance. What does the term choice mean in dollars?
Here is a simple example. If the borrower renews at 4.15% on a 2-year fixed, the interest cost in year 1 is roughly $16,600 on a $400,000 balance. If the same borrower takes a 5-year fixed at 4.45%, year 1 interest is about $17,800. That is about $1,200 less in year 1 for the shorter term before you even count the flexibility value. Over 24 months, that gap can matter a lot when household budgets are already under pressure.
So the real upside is not just a slightly lower rate, it is buying time. But what is the trade-off if rates fall faster than expected?
Then the shorter term wins only if the future rate drop does not outweigh the extra cost of rolling again. That is why term length is a strategy decision, not a prediction contest. Framework 1. Choose the shortest term that matches your certainty window. If you know you may move, refinance, renovate, or change jobs inside 24 to 36 months, a 2-year or 3-year fixed usually fits better than a 5-year lock. Framework 2. Choose the longest term only when the payment is affordable and the stability is worth paying for.
Give me a second example, this time with payment shock. A lot of listeners are not comparing rate spreadsheets. They are reacting to a much higher renewal payment.
That is the real story. The Bank of Canada has noted that many borrowers renewing from pandemic-era rates are facing much higher payments, and industry estimates for fixed-rate renewers in 2026 put average increases around $622 per month. On a typical renewal, that is $7,464 more per year. If a 3-year fixed trims even $200 per month versus a 5-year fixed, that is $2,400 a year in breathing room. For a household balancing daycare, transit, groceries, and tax bills, that cash flow relief can be more valuable than squeezing out a slightly longer lock.
What are the warning signs that short-term fixed is the wrong move?
Red flag number 1. Choosing a short term only because the rate looks lower, without a plan for the next reset. If you ignore your future income, you can get hit twice, once at renewal and again when the shorter term ends. Red flag number 2. Assuming a short term is always cheaper over the full period. It is not guaranteed. If rates stay elevated, you may renew into another expensive contract. Red flag number 3. Forgetting break costs and portability. A homeowner who expects to sell inside the term should compare penalty risk carefully because the cheapest looking rate can become the most expensive mortgage on paper.
Let's do one more real-life scenario. Say a family in Milton has a $350,000 mortgage and knows they may move in 2 years. What would you say?
A 2-year or 3-year fixed is usually the cleaner fit there. If they lock at 4.05% instead of 4.45%, the annual interest difference is roughly $1,400 on that balance. More important, if they move, they avoid being tied to a longer contract that may trigger a larger break penalty. So the decision framework is simple. If your life horizon is shorter than 5 years, match the mortgage term to your life horizon unless you are deliberately paying for long-term certainty.
That is the key takeaway. Term length matters as much as rate type. If you are renewing soon, think in 2 questions. How much payment certainty do I need right now, and when do I want my next reset? That is it for this episode of Your Mortgage Minute by onlendhub.ca.